By the way, who's new here? I should always ask that at the beginning. Who's a new person? 1, 2, 3? Oh, cool, good, excellent. Well, just to let you guys know, we have 2 meetups a month. We have a basic casual drinks meetup, which is on the 4th Wednesday of the month, and on the 2nd Wednesday of the month, that's this Wednesday, we have a more structured presentation-based event like this. So tonight what we're going to be talking about is something I think that everyone can relate to and everyone finds somewhat interesting, although it's not without its controversy, but that's the idea of what the fiat-denominated price of Bitcoin is. I use those words because if you just say price, it sounds like that's all you care about. It's a speculative instrument. Clearly, we have this idea that 1 Bitcoin equals 1 Bitcoin. Yeah, that's right, that's true. But one of the major drivers of Bitcoin adoption has been the extent to which the purchasing power of any Bitcoin people buy goes up. And that, at this stage, while we're still before the what do we call it, the predictive hyper-Bitcoinization, we're still in the stage of having to measure Bitcoin's purchasing power in terms of fiat money. And it also, as it turns out, for better or worse, it's been one of the great drivers of adoption, has simply been this idea that, well, people see, they get the media hype cycle happens, they see the price going up, and they want to get in on that. And I know that it can sound rather crass, you know, thinking about what the price, I mean, but the thing is, it's not unimportant, but it's obviously not, it's not everything either. For some people, the price of the thing is all there is. Clearly, that's not the case with Bitcoin. But a lot of people are lured into Bitcoin, or I'd say, right word lured, but they do adopt Bitcoin initially because they see its purchasing power go up compared to the fiat that they already own, and they want to they want to adopt it as their money, as their savings account. So, and then after they do that, then they start to learn about the nuances of Bitcoin and all the other great things that make it a superior form of money. Anyhow, to that end, there are a number of potential ways we can speculate upon what that trajectory is going to be, and that's what we're going to be talking about tonight. James is lead analyst for Glassnote, which is a company that uses on-chain metrics, so on-chain data. It looks at the Bitcoin blockchain, analyzes all of the transactions on it, and attempts from that to make various predictions about how have all of the weak hands been shaken out, or what the distribution of the coins is, or does it look like all of the sellers? This sort of thing that maybe gives you some idea about where the price is going to go. And then in the second half of the evening, I'm going to invite Peter Dunworth to come and join us on the stage. Peter has been on the rounds of podcasts recently doing some great analysis of what he sees the future of Bitcoin going to be, and he has a rather staggering Bitcoin price prediction, which is, well, we'll be very interested to see the justification for that and perhaps flesh it out. And you guys, of course, you'll have the opportunity to ask questions and really scrutinise the ideas. So anyway, without further ado, I'll hand you over to James, and this one's going to be great. I've taken a look at the slides, so really looking forward to hearing James's talk here tonight. Thanks, guys. Space bar.
Nice one, easy. Right, so as I said, I'm James Check. I lead the team over there at Glassnote. So quick question, there's a few newbies to Bitcoin. Who has never heard of on-chain analysis before? Well, someone has to, surely. All right, who thinks an on-chain analysis is a complete scam? Oh, good crowd. So this beautiful chart here, and what I love about on-chain data at the end of the day, is it's looking at the heartbeat. And Bitcoin has a heartbeat, it's every block, every 10 minutes, it's the hash rate, but also it's us. Every single person who touches, interacts with, signs a private key, hashes, makes some immutable decision that gets imprinted on Bitcoin. All of our collective decisions get made and imprinted forever. So within that, human beings are very emotional creatures, right? We buy at the top, we sell at the bottom, we learn, fuck, that was a bad idea, and then we try and do the opposite next time around. Now, some of us have done that 3 times, once, 2 times, and we get more and more experience. So you get the smart money, you get the dumb money, you get the people with $10, you get the people with 10 million. So what the on-chain data is really looking at is the whole spread of all of our collective decisions within the context of the technical constraints of the block size, the number of transactions we can do, all of that gets printed on-chain. So anyway, what we're going to look at today is the 2023 bear market over? And the answer is we don't know, no one knows. But what we can do is say, do we have the conditions of human behavior? Have we seen the types of things that put a bottom in? Have we seen the type of behavior that comes out the other side? Just looking at things from a series of lenses to say, if a bear market was to be open, what do I want to see? And do I see those things in the data itself? Right, so we're going on a bear hunt, and we're going to look at this from 3 different perspectives. First one is price performance, right? What do you typically see coming out the arse end of a bear market? Well, less red candles is a good starting point. So do we have those typical conditions that kind of just inspire people to say, hey, shit, something might have changed? The second one is hodler dominance. At the bottom of a bear market, who do you want standing next to you? You want people who've done the research, come to Bitcoin meetups, kind of obsessed with this weird and strange internet money that we all love. You want to see all of the speculators gone, and you want to see the exact opposite. You want to see all of the hardcore people who know why we're here to be in the dominant cohort holding. And then we're also going to look just more a bit of an interesting thing about shrimps and whales, right? People love to talk about shrimps and whales. I just want to kind of give you a bit of insight into how to really look at this type of data and actually make something useful out of it. So this chart here assumes we still are in a bear market. Now in a bear market, you also get rallies. Price still goes high, often with some gusto, right? In a bear market, you get these rallies that go, oh shit, the bull market's back, and people jump in and then the thing gets dashed. And what you'll see with each of these charts, this is all the different previous cycles, and the section at the bottom here is looking at how much price rallied from the local low, right? We've gone down to a new low, how much did we then rally? It's basically a gauge of how much excitement came back into the market. Now, the higher these color charts go, the more exciting. The lower they go, the more people are going, oh, I'm just fucking sick of this thing. I'm tired of getting my ass handed to me. And eventually, you just give up. So the red arrows you can see is kind of over the course of the bear market, things get closer and closer and closer to zero. There's no more green candles. It's just red. It just goes down. And it's painful, right? If you went through the 2022 cycle, it is bloody painful. Now you can also see at the end of those bear cycles, you get a bloody big rally. And it comes up off the bottom, and these ones here are actually curtailed at 100% gain. So these things actually go off the page, the thing disappears. So when you're coming from 15,000, right, where we were a couple of months back, all the way up to 30,000, that's a 100% move. That is generally enough for people to go, that was different. That wasn't your typical bear market rally. This thing's, I mean, it's still there, right? It just kicks and changes that gear in people who've been looking at the price graph. So the second equation is to say, okay, well, let's assume that we're in a bull market, because again, we don't know. Let's assume that we are. This is now looking at the corrections on the way up, right? Because nothing goes up in a straight line. You do get these pullbacks. And you can see here, some of these pullbacks get down at 61%. You lose more than half of what you held. So these pullbacks can be pretty nasty. And what I just want to highlight is look at this tiny piddly little thing here. We've barely got more than 10% pullback. So far we've had that 100% rally off the bottom, and we've given absolutely nothing back. Now the first takeaway from this is that expect us to give something back, because it gets worse literally every single previous time. So it will go lower at some point, but so far it hasn't. So you kind of put those two pieces of the puzzle together and say, okay, it's not a bad move off the low, and we seem to have been holding it so far. Now moving into the on-chain side, because price is by far the least exciting part of this equation. This here is looking at the percent, so you've got all the coins in the Bitcoin supply, what percentage of them were acquired at a cheap price, right? Now, at the very arse end of a bear market, and you'll see at all these points, when we rally, we get these enormous rips higher. A very small incremented price. If you go back to the 2015 market, we went from 235 to 330, right? In a percent terms, it's meaningful, but that's $100, right? Went up $100, and yet 18.5% of the entire Bitcoin supply is suddenly in profit. What does that tell you? 18.5% of the supply bought their coins at a lower price than where we are at $330. It shows you the foundation of both sellers who capitulated and said, fuck this, I'm done. And the other people who step in and go, thank you very much. I will take those coins at $235 and good luck to you. Same you can see here in the 2018 market. You can see the severity, how fast that thing moves higher. It's telling you the magnitude of coins that were acquired below us. We've flushed out all of the sellers, and we now have a bunch of people who are strong hands. No one sticks around through a bear market who doesn't know why they're here. and suddenly you've got 22.5%, or in our case, 23.8%. 74% is now in profit. So you've only got that top quarter who is still underwater on their position. So it shows you that lots of people stepped in down here at the $16,000 level. So what we can also do is track different cohorts of people. And the most important question is, when did you acquire your coins? Because someone who acquired their coins 5 years ago is probably a bit more steel-hardy than someone who bought yesterday. Now there's really two insights here. These are different models. The red one, the red curve is looking at people who recently bought in the last 5 months, right? People who speculate, chase price, or at the bottom, people who bought the bottom. The blue is looking at the other side of the equation, who've held their coins for more than 5 months, and then the orange is the average. But to be honest, that's less important than the shape that they make through cycles. During a bull market in these blue zones, you can see that they separate, they diverge. People who recently bought are chasing price. They're speculators, they're traders, they're following the market. Their cost basis is much closer to the spot price. People who bought in the last bear market, they're sitting pretty, right? If you look at last cycle, they're sitting pretty at $3,000, $6,000. I don't care the price is 60 grand. Like, my cost basis is irrelevant compared to that. So you see that their cost basis is much, much lower. But this divergence is exactly what creates the start of a bear market. A bunch of people bought the top. And there's a bunch of people from previous cycle who are selling to those brand new investors. You tell your best friend, this is my story, 2018. You should get into this crypto thing. It's great. $10,000 becomes 10 cents. What a great fucking decision that was. It's a process, right? So these people who are buying, you can see this red curve. Look how long it spends at the top. These are people buying the top of the market who are then going to get fleeced for the next 12 months until we get to the point when all of these cost bases converge. Why do they converge? The speculators are gone. The inexperienced are gone. The people who don't have any idea what they're doing are gone. The people who came for the price are down 90%. They just give up. They're done. You have a convergence of all these cost bases because the only people who are left are the same guy. If you've been here for 5 years, 2 years, 1 year, 10 minutes, you're the same hardcore person who understands why Bitcoin exists. This homogenization of all these cost bases, irrespective of when you helped or acquired your coins, is a characteristic of bottoms because there's no one left. It's only the hodlers who remain. And we can see this. This chart here is one of my absolute favorites. This is looking at the entire coin supply. So the y-axis is the number of BTC. X-axis is the price where they were acquired. So what I can see is you've got the sub 15, these are people who held for the whole cycle and didn't spend. They still hold their coins from, many of those are lost. Satoshi's in there, people from the 2018 bear market are in there, people with sub $15,000 acquisition prices. Many of those will be lost. You've then got the top band here, people who bought above 30,000. They're blue because they've held them for more than 6 months. Red, shorter than 6 months. These people are either seriously insane, or they're waiting for their cost basis, or they're not going anywhere. Right? So they're pretty hardcore, these people as well. They're the survivors. And then you look at the zone between 15,000 and 30,000 where you currently are. There's a shitload of coins that have been acquired down there because they were people who sold. That's the speculators getting flushed out, and the more hardcore stepping in and buying this thing. FTX, when that blew up, the narrative was Bitcoin's dead for 10 years. Imagine stepping in front of that train. That's what all this is showing. So I don't know if the bear market is done, but when I look at this kind of spread of information, you see that there's a lot of people who believe that 15 to 30K was a bloody good deal, and they're not going anywhere because of it. So to me, that's the foundation you want to see to put the end into a bear market. Add in there a 100% rally from the bottom. You may go back down to 25, you may go back down to 24, who knows? But what I can see is that there's a bunch of people who saw value back there. They're pretty insane. They'll probably do it again. So that chart that's a snapshot. That previous one that is the current distribution of supply as it stands today. Well, obviously every day, some guy spends, some guy transfers, some guy sells. This beautiful chart, it's just here, which is beautiful, is basically showing you every single snapshot, what that chart looked like as like a volume profile. So the important thing here is the red colours are recently acquired coins. Now, when do those recently acquired coins get the hottest? At the top. That's when the maximum number of brand new buyers have just stepped in and bought coins. Now, how does a coin become young? it was sold by a guy who's holding it for 4 years. Buys in the bear market, lets it mature in his wallet, and sells to the brand new guy at the top. This is how Bitcoin market cycles tend to play out. So if you look at a bear market, right, 2019, good example, or our cycle, you'll see these red zones are people capitulating out. Get me the hell out of this asset. I'm down 75%, I'm done. What you'll then see is that it goes, the red disappears, right? Through all of 2019, very, very little red, relatively speaking. That's because coins are maturing. They're hodlers who bought the lows, continue to dollar cost average through this reaccumulation period. They're not going anywhere. They are waiting for this. They're waiting to sell to the brand new guy who's going to buy his, 4-year-old coin. There you go, it's 24 hours, thank you very much, right? So keep those red and cool colors in mind. This one here is looking at the coin supply, y-axis is percent, but this is not the amount of coins. This is based on the dollar wealth, because quite frankly, I don't care that Satoshi's got coins that are 10 years old, because he acquired them at $0. They're worthless. I don't care about them. What we're valuing here is the percent of USD wealth. If you buy a coin, one BTC at $10,000 and you withdraw it to your wallet, you invested $10,000. And until you spend that coin again, it will always be $10,000 in this model. So it looks at the dollar wealth invested. It's way more important than the coin value because there's a bunch of lost coins and no one cares about. So this is looking at all of the money that's younger than 6 months. And what you'll see is the hot zones, the maximum proportion is at the bull market tops. This is literally guys coming in buying the top. And who sold them that coin? The experienced money. So if you're trying to work out where we are in the cycle, and you want to follow the smart money, don't buy when that thing's big, right? Because that's showing you there's a bunch of people who have no idea what they're doing, buying off people who do, right? You want to be on the other side of that equation. And the key note here is that you'll see that at the bottom of the bear market, there's the minimum amount of wealth in these young coins because buying and holding becomes the dominant and preferable behavior. Who do you want to see around? This is the exact opposite. This is the white space of that previous chart. At the bottom of the bear market, you see the maximum wealth held by coins at 6 months, 1 year, 2 years, 3 years. These are people who've stuck their coins in cold storage and they're not going anywhere. And as you can see, we're pretty much at an all-time high, particularly for very old coins. So there's a lot going on. So the third topic I just want to touch on is, I thought this has been the most fascinating chart to kind of build and understand over the last couple of months. So what we were looking at before was how long people have held their coins, the holding time. Right? This is one of these rare things we can do with on-chain analysis. There's 2 things you can do with on-chain analysis you cannot do with traditional finance. Measure when everybody bought their coin, time, and what price they bought it at. Right? So when you spend your coin, you bought it 60,000 at 20,000, you're locking in a loss. When you buy it at 20,000, sell it at 60,000, you're locking in a profit. You cannot see this information in traditional finance. This one here is now looking at the supply, right? When we're looking at, we call them shrimp, crabs, they're sea creatures, right? But they're basically looking at, do you have less than 1 Bitcoin, 1 to 10, 10 to 100, which bucket do you fall in? So here we're looking at the shrimp. And why do I care about the shrimp so much? Well, the shrimp is the average person. The average person is not buying more than 1 Bitcoin in any one monthly clip, right? So typically speaking, most people, most retail investors, which at the end of the day, that's what this thing's about, right? It's about retail and at the ground up. You're going to get institutions, but I don't particularly care about Michael Saylor. Bitcoin to me is about everybody else, right? It's all the real people in this. So the thing with the shrimp, when we look at under 1 BTC, if you never mix your coins, like you combine UTXOs, typically if you're buying and withdrawing once a month, typical DCA behavior, almost every single one of your coins will show up. You may have more than 1 Bitcoin, but you'll still be a shrimp unless you combine all your UTXOs and we can see, oh look, all of those belong to the same person. So for the most part, this will catch most of retail. Now, the top chart, or the line chart, is the total amount of supply they hold. The chart at the bottom here is the 30-day change, right? How many coins do they add or subtract from their balance each month? First thing to note, it's never gone negative. Shrimp only buy. They just buy. They just add to their wallets. They never go negative. The second thing, the 2017 peak was the all-time high, 50,000 BTC per month added, and you can see that's literally people buying the top. But look at when we match that level. At the not top. Shrimp. Now, I got in on that 2017 top. The volume, the quality, the scale of Bitcoin education, understanding, awareness is exponentially larger than when I got in 2018, and it's exponentially larger than it was back in 2013. So the amount of good information that's out there that would say, hey, this thing's actually probably not going to zero, it's probably a good idea to at least have some, given the world that we all live in. I see this in that psychology in this chart, because the last time they bought this much was at the top, and here they are buying 3 events at the bottom, and not only that, the baseline continues to increase. Now the other thing here, right now, where we are right now, these shrimp are accumulating 28,000 BTC per month, which is exactly how many coins are being mined each month. So therefore, every other person who's not a shrimp is taking coins off somebody who's a seller. The miners are essentially nullified by the shrimp cohort, which is a pretty remarkable finding. But this psychological shift here, buying at the bottom, is a completely different mindset. Taking that concept of how many coins are being mined, we're looking at this over 1 year. How many coins are mined over a 1 year period? I've got shrimp in orange, I've got crabs 1 to 10 BTC in red, and fish 10 to 100. These are just different wallet cohorts. What's more important here is that this here shows that they're accumulating every single coin that's mined over the last year. The shrimp are at like 117%, the crabs are at like 110%, and the fish are like 78%. So where are those coins coming from? Because they're acquiring more than the 100%. This assumes that miners sell everything that they mine, which for the most part they do. These coins are coming from 2 entities, miners, but whales, who have been net distributors for many years. For about 6 years, whales have just been net distributors. And these are 1,000 BTC plus. But it is important to note that in that purple category, that includes the GBTCs, that includes the MicroStrategies, that includes every ETF. Within that whale cohort, you're basically looking at a net distribution via the, people say Bitcoin is held by 5 wallets and they have 98% of the supply. Bullshit. Absolute bullshit. We can prove it by looking at how these coins distribute. Within that purple is GBTC, which is held by millions of people. MicroStrategy. Many people own these ETF type products. So what you're actually looking at is a whales distributing, exchanges, self-custody, coins flowing out of centralized entities, and the shrimp, crabs, the smallest cohorts out there, are buying all of them. So, pretty sure that's my last slide. The general view here is, when I look at, is the bear market over? We've had a bloody strong rally off the bottom. We've got a hodler-dominated market. We've got all of the speculators have been flushed out. And we've got exactly the kind of people that we want to be stepping in, who appear, this chart, these strange, weird people who happen to have learnt their lesson about not buying the top, are currently buying what is not the top. So to me, I kind of look at all that spread and you go, well look, we don't know if the bear market's over, but from a probabilistic standpoint, a lot of conditions we want to be seeing if a bear market is done for. Now, the reality is that Bitcoin goes through these reaccumulation periods, right? Generally speaking, 2019 is a great example. We went back down to 3,800. But I remember my own behavior back there in 2019. I didn't really care that it went down because I'm learning about what this thing is. I'm looking at the debt pile that's coming. I'm looking at the macroeconomic environment. I didn't know COVID was coming. I didn't know the Fed was going to print $4 trillion. But I knew something like that was going to happen eventually. Bitcoin's a bloody sane decision when you look at all that in context. So, I kind of look at that spread and I say it's good odds. At the very least, the 2022 bear market may well be behind us. It could be a rocky road north, but certainly you have the conditions in play that you'd want to see in that environment. Do you want to add? That's me.
That was terrific. Thank you, guys. We're a little bit ahead of schedule, so we could perhaps open it up for Q&A right now, and then we can continue that after the break with when we get Peter up on the stage. I might kick off though, James. You might recall a conversation that was going on in the Bitcoin Live speakers chat, and I had some question. I've always thought, basically the question was as to what impact the halving. Does everyone know what the halving is? Has everyone heard of the Bitcoin halving? So that's, no, I'll quickly explain what that is. So as James mentioned here about how there's miners that are responsible for selling a lot of coins. Well, where do the miners get the coins? Well, miners are obviously securing the network, and they get rewarded with, at the rate of, at the moment, 6.25 new bitcoins every 10 minutes. So just to pay for the electricity that they use, they very often have to sell those coins. So that's what's coming on the market right now. But every 4 years or every 210,000 blocks, that issuance rate gets cut in half. And so the question then becomes, to what extent does that, we would call a supply shock, have on the price? Now, of course, we have this debate every time the halvening is imminent, but one thing that has occurred to me over the last couple of years is I've looked around a lot of the people that I've known from the early days, and a few of you here might know these people, and you see these are the whales that James talked about. And you might have seen them buying, a few of them I've seen buying everything from light industrial units to hypercars to real estate and businesses all over the place. And then you start to think, I wonder how this 6.25 or the upcoming only merely 3.2, I wonder how much the actual mining supply and how much of a difference that can really make. Might that just be a drop in the bucket compared to these whales that are essentially, and every new cycle breeds a new generation of whales that now want to upgrade their lifestyle. So maybe that's something you could cover, James, or talk about whether you think that is a drop in the bucket or whether it could have a real impact.
No, it's one of these things that the only guarantee is that the halving debate will show up every halving. Is it priced in? Is it not priced in? I mean, who knows? When you actually look at it, the amount of mine supply was at 900 per day at the moment, 450 after halving. It is insignificant. It's like less than 1% or thereabouts of trade volume daily. It may be more now that we're kind of in bear market territory. You've got liquidity's kind of drained, given the macro environment. So that's one thing I didn't mention. It's probably going to be pretty volatile because liquidity has drained significantly from this market. So we're going to get some pretty crazy whipsaw maneuvers, but that's what Bitcoin does. My view is that the halving is far more psychological. And particularly when you look at the macroeconomic environment, right? We sit around once a month waiting for a bunch of grey hairs in the US to decide what is the price of money, right? And the market whipsaws around like, it's ridiculous. When you actually look at this thing, it's the most ridiculous system that we have. The halving comes around every 4 years and goes, you can't stop this thing from, like the monetary policy it's fixed. You cannot change this. So when it halves, it's more of a, what do you call it? It's almost like a stark reminder that Bitcoin is just going to continue to do what it does, with no one able to stop it. Meanwhile, we debate every man and his dog, well, what's the interest rate going to be? 25? Is it 50? What a meaningless waste of our brain power. So in many ways, the halving is a psychological game. In terms of the mine supply, miners have always, through their entire history, there's been net sellers. Pretty much every coin that gets mined, they sell. It's a very common pattern. We've seen very few deviations of it. The only real major deviation was in 2019 through to 2022. And the hilarious part is that the expectation was, look, miners have industrialized. They've got better at what they do. They've got capital markets in the US. They're going to survive this bear market. No, they did exactly the same thing. They sold the bottom, right? They acquired all their coins up to the top, and then they got fleeced all the way down and sold at the bottom. So miners are historically pro-cyclical. They sell at the same time when you should be buying, and they buy with power at the same time you should be selling. So they're kind of net distributors always. It's kind of the only constant in Bitcoin is that miners will do the wrong thing and sell. So in that regard, you're right. Whales, any other entity who's made money, some of these guys will sell 6.25 BTC on an afternoon, right? That's an entirely new day of block reward. So in many ways, the investors have far more of a say than the miners do, but the halving remains a psychological phenomenon. And for whatever reason, this 4-year cycle just continues to play out. So how long that lasts, I don't know. It keeps going.
It does, and of course the last time I think that the last bear market, I think there were a lot of people who didn't believe that the halving was priced in, and when you see that, I don't know what you think about this, James, when you see that widespread sentiment, that's often an indication that it actually isn't priced in, because if they're all thinking that it's already priced in, then their behaviour as a result of that would probably be not to be buying. And so then they see the price start to creep up, and then they kind of have to buy because they were caught short due to their own prediction, fulfilling the very prophecy that...
Basically that idea of like, it's not going to go up after the halving. is very quickly dashed once you get that first 10% candle. And then people just go, oh shit,
it is.
maybe it's not priced, they're just chasing and it's game on.
Yeah. Would anyone like to ask a question now, or we can take a break and then come back and, yeah, we can do it. Is it from the mic? Or let's take up that one.
Yeah, take that, I can yell.
Yeah. And I'll get another one here.
James, thanks for your insights today. I've been subscribed to Glassnote for a little while, and shameless plug here. Glassnote accounts are free. There's like a base tier and some good insights. So I recommend everyone just get a Glassnote account. It helps you pick your entry points. James, the question is, the on-chain metrics paint a very bullish scenario. If you were to use the on-chain metrics to paint a bearish scenario, what would that look like, and how would you, what metrics would you use for that?
Great question. Testing.
Is it working?
Hello?
Oh, there we go.
There we go. So the main thing that I'm looking at the moment, so in fact we were talking about it before.
Keep it kind of close.
The thing we were talking about before was adoption. So adoption is a really important and interesting metric because there's lots of ways to measure it. Transaction counts, active addresses, volume, what matters more? And the question is, well the answer is they all matter. But to varying degrees. So what I'm looking at the moment, particularly on the adoption front, active addresses is falling off cliff, which is kind of interesting. Transaction counts are at all-time high, and transaction volume is everything but exciting. Very, very lackluster. So what does that tell me? It tells me there's a bunch of shitcoiners who have no idea that Bitcoin has a UTXO model and are essentially treating their Bitcoin addresses like an Ethereum address with all these inscriptions and all that shit. So that's the first one. The second one is, so that's why active addresses are falling off a cliff and transaction counts are at all-time high. Transaction volume, which I often refer to as like the payload, because if everyone's moving around shrimp balances, right, transaction counts are all-time high and they're moving 10,000 sats. That's a different story into if transaction counts are all-time high and they're moving around 15,000 BTC, whole different ballgame. So this speaks to a low liquidity environment. And whether we like it or not, I don't know if this is helping or hindering.
If you keep it perpendicular, that's better.
There you go.
Sorry, what's happened?
Yeah.
Tarry, just press the button on that mic. I think that might be interfering. We'll just stick with one mic, I think. Yeah.
Whether we like it or not, there we go.
There we go. All right.
Bitcoin remains tethered to the macro environment for all the right reasons, in the sense that it's outside money and it's a big middle finger to the system to be. However, traders with big money who are going to trade this thing, whether we like it or not, they will sell everything if we get some kind of recession event, because they just say 20% off, sell everything. I don't care what it is, just get it off. So in a macro environment, which we have to keep in mind, there's that. The adoption picture is what you would expect to see during the early phase of a bull market, where most people still believe it's dead, right? Adoption is, the only people who are left are us. There are no new money coming in. They'll come at the all-time high, but that's the time when you start saying, well, probably doing the opposite. So in many ways, we're kind of in that early bull market phase where the bear market is just going to be bloody volatile, it's illiquid, it's going to go up, and then it's going to go really down. And that first chart, you can see that minuscule pullback we've had. It's nothing. It's going to get worse at some point. And people are going to say, this bear market's over. Oh no, PTSD kicks back in. So the bear market is, the bear case is it's probably got some time, there's time pain, and there's just volatility, which is kind of par for the course. But something that I personally found, the way I solved that problem, is by learning about this bloody thing. Once you understand what you're looking at, why it's doing what it's doing, and I get people say this to me when they watch the videos, it helps me hodl. That's why I do it. That's why I make the videos every week. It's because people can make it through the volatility. And if you make it through the volatility because you understand why, I mean, that's fantastic, right? It changes people's lives.
Actually, James, I wanted to pick up on something you mentioned there, the extent to which people or institutions or big traders would want to sell their Bitcoin, and maybe you can comment on this idea, but it used to be that Bitcoin was considered somewhat of an asymmetric hedge to the legacy financial markets. You would see how, it was considered like the safe haven that you would go into when the shit's hitting the fan everywhere else. But what we've seen in the last few years is a much closer correlation. And is that because perhaps traders are realizing that here you have you sitting on this thing that's super liquid, very easy to sell. And so if you've got Bitcoin, you'll have, and the market, the traditional financial markets are tanking, well, you can sell your Bitcoin in order to cover your short positions, or rather your long positions, in a tanking market, and bail yourself out of your other bad investments. Is that kind of more the way Bitcoin is headed now in that respect?
Yeah, that's definitely part of it, right? So during these what we call correlation one moments, everything's just going down, right? March 2020 is the perfect example. Everything sold off. Doesn't matter what it was, everything goes straight down. And that's literally, the market just says, take 20% off the books. I'll just sell, I don't care what it is, I don't care what you bought it for, just get it off, right? We just need cash, safe haven. Now, Bitcoin continues to go through this, I mean, it was uncorrelated, right? There was no measurable correlation to any other asset class up until 2020. 2020, things changed. We did get a very strong correlation. And this is literally, I mean, you have to come to terms with the fact that Wall Street is the world's greatest casino. And they've done it the best. They've done it better than anyone else with the biggest money. And Bitcoin is another game for them, right? They can put money on, they can trade the volatility, they can, you know, what we're seeing at the moment actually is that options, which is a preferred instrument for hedging and speculating, is now surpassing futures. This is part of the institutional behavior of Bitcoin, is that options are starting to grow. That it does trade in line with where people's positions are. But the big trade-off here, and it's like gold, right? Gold for for centuries has kind of been that safe haven. And if you look back at 2008, right, it's kind of an interesting exercise. Go on TradingView, look at the stock market, S&P 500 or whatever index you want to look at, and look at the drawdown that it saw during 2018. Then overlay the gold price. It went down 20%, but it didn't go down 50%. And it recovered real quick. Bitcoin did the exact same thing in March 2020. It was the asset that, yeah, everyone sold it, but then they realized, fuck, that was a bad decision, and they did the exact same thing, they reverse course. So in many ways, and we actually saw this, post-FTX, we've started to see Bitcoin, you know, how you want to measure dominance is a question mark, but kind of traditional market cap-based metric, Bitcoin dominance starts to rise. We're seeing lower liquidity in pretty much every other sector of the market. All the NFTs and all this stuff starts selling off. What you're seeing is a rotation back to, this makes a whole lot more sense. And you see the market return back to, all right, I mean, let's just think about it for a second. How many narratives, coins, tokens, all money, VCs, funding raises, all of this has happened for the last 14 years. Well, 10 years if you want to count alt. Nothing has flipped Bitcoin, and all it does is settle value. It's the most boring boomer coin of all time, and yet it's just so unbelievably amazing in the sense that nothing has been able to prove that, oh, look at my 15 features, they're more important than yours. And the market just says, well, you're wrong. You are consistently wrong time and time again. So just that simple fact that Bitcoin continues to have a more than 50% dominance across the rest of the market. And talking about dominance, lots of people like to look at the TradingView, Bitcoin dominance, Bitcoin.D. The problem with that is that there's a couple of problems there. The first one is that market cap is a shit metric. Satoshi's coins are not worth $28,000 because if he sold them, it's never going to happen, right? And also, they've been long dormant, lost. It is not fair for Bitcoin to say that those coins are measured at the current spot price. It's just an unrealistic thing. Likewise,
wouldn't that reduce Bitcoin's market cap?
Yes, it would.
In a way that would make it feel less dominant? I mean,
no, because when you do it to every other coin, yes, you are talking about 90% drops because all their coins are centrally mined, right? And this is what we call the realized price or the realized cap. I only want to see the value of a coin when it's transacted on chain. And you can do stuff where you filter, right? So like if Ripple just sends to themselves, you filter that shit out. But if you look at it on a market cap dominance, Bitcoin's like 46 or whatever it is %. Couple of problems. One, for Bitcoin's fault, we're valuing lost coins, but that applies to all projects. Simultaneously, you're also taking stable coins into account. Well, if you're going to do that, Bitcoin dominance is like 0.1% because you've got to consider all fiat. And stable coins really just an extension of the US dollar. And the other one is that if you look at illiquid, this is what happened with FTX. They took their tiny book of these shit coins that had no market depth and said the whole market cap is worth this much, and now we're going to borrow all this money against it. Realized cap removes that. Now, if you do a realized cap dominance, price every coin at the price when it last moved. Bitcoin dominance has been in an uptrend since that 2017 peak. It's currently up over 65% last I checked, and every other, and that includes, if you include stablecoins, if you remove stablecoins, it's even higher. So when you look at that frame of reference, I mean, dominance is just up only. Peter.
The last point you made was really critical. I was just wondering, if you remove stablecoins from that, what does that dominance look like?
So if you remove stablecoin, sorry, I think I made a mistake. I think if you remove stablecoins, you're talking about like 65%, and in an uptrend since the 2017 peak. So if you include the classic market cap BTCD on TradingView, that includes stablecoins and every shitcoin that's been printed that has a price. We value every coin at that price, but it's just not real. So realized cap dominance is an uptrend for 5 odd years and 65%.
Thank you.
What we might do, Dylan, if you don't mind, if you could hold that question till after the break, because we're going to get, there'll be more, you'll have more opportunity to ask James about that. We can flesh out some more of these issues. We'll get Peter up, and that's going to be really a lot of fun to hear Peter's predictions of some of you may have heard on the podcast. But for now, we'll take about. Sorry, what was that? I missed that. Oh, okay. All right. But for now, we'll take about a 10-minute break. And we'll come back, so about 8, and we'll kick it off again for another 45 minutes. Thanks, guys.
James.
Thank you, James.